Right now, at this very moment, there is a ticking time bomb buried deep inside your retirement account, and you have no idea it's there. This isn't hyperbole. This isn't fear-mongering. This is mathematical certainty wrapped in financial engineering so complex that even the fund managers holding your money don't fully understand the monster they've created. I'm talking about $1.7 trillion in private credit debt, a shadow banking system larger than the entire subprime mortgage market that destroyed the global economy in 2008. And unlike 2008, this crisis is deliberately hidden from public view, operating in complete darkness with zero federal oversight, zero transparency, and zero accountability. If you have a 401k, a pension, a target date fund, or a life insurance policy, you are almost certainly exposed to this unregulated debt bubble right now. The companies that borrowed this money are drowning. The interest payments are crushing them. And the accounting tricks being used to hide their insolvency are about to collapse under the weight of economic reality. Before I reveal the specific mechanism that's draining billions of dollars from pension funds in real time, make sure you're subscribed to this channel and hit that notification bell. This information could be the difference between a comfortable retirement and financial devastation. And comment below with either protected or exposed to let me know if you think your retirement savings are safe in this economy. Because I promise you, after the next 15 minutes, you'll never look at your retirement statement the same way again. To understand why this implosion is inevitable, we need to examine where this mountain of toxic debt actually came from. After the 2008 financial crisis nearly destroyed capitalism itself, regulators came down hard on traditional banks. They passed the Dodd-Frank Act, implemented stress tests, and created capital requirements that made it extraordinarily difficult for banks like J.P. Morgan, Wells Fargo, and Bank of America to lend money to risky companies. But here's the critical thing most people miss. The demand for debt didn't disappear just because banks stopped supplying it. Struggling companies still desperately needed cash to refinance existing loans, fund operations, and avoid bankruptcy. When the front door of traditional banking slammed shut, these companies went around to the back door. That back door was private credit. Private equity firms and asset management companies stepped into this regulatory vacuum and created a parallel banking system, one that operates by completely different rules, or more accurately, by almost no rules at all. They established private credit funds to lend directly to these risky, over-leveraged companies, bypassing the entire regulated banking system and all of its safety mechanisms. No reserve requirements, no stress tests, no transparency, no oversight. For the past decade, this seemed like financial genius. Interest rates were pinned near 0% by the Federal Reserve, pension funds managing the retirement savings of teachers, firefighters, nurses, and police officers were absolutely desperate for yield. Government bonds were paying virtually nothing, maybe 1 or 2%, which wasn't nearly enough to meet their obligations to retirees. So pension fund managers poured hundreds of billions of dollars into these private credit funds, seduced by promises of steady 8, 10, even 12% returns with supposedly low volatility. The marketing pitch was irresistible: stable income payments, immunity from stock market chaos, and professional management of carefully selected loans. But that safety was always an illusion, a mirage built on a single catastrophic assumption: that interest rates would stay at zero forever. Then the Federal Reserve shattered that assumption. To fight the worst inflation in 40 years, the Fed launched the most aggressive interest rate hiking campaign in modern history. They took rates from 0 to over 5% in less than 18 months. And here's where the trap springs shut. Almost every single private credit loan has a floating interest rate. This means the interest payment automatically rises when the Fed raises rates. A mid-sized manufacturing company that was comfortably paying 5% interest 3 years ago is now being crushed by 12 or 13% interest today. Think about that for a moment. Their debt service costs more than doubled. Overnight, their entire business model collapsed. Thousands of American companies, the backbone of the middle market economy, have been transformed into what financial analysts call zombie companies. They generate just enough revenue to pay the interest on their debt and absolutely nothing else. No money for worker salaries, no money for equipment investment, no money for innovation, no money for emergency reserves. Just enough to keep the interest payments flowing to the lenders while the business slowly dies. In a normal, functioning free market, these zombie companies would declare bankruptcy. The bad debt would be recognized, written off, and flushed out of the system. Healthy companies would buy the assets at reasonable prices and redeploy them productively. But the private credit market is not a free market. It's a manipulated ecosystem specifically designed to hide failure at any cost. Fund managers know exactly what would happen if these zombie companies started declaring bankruptcy in large numbers. Pension funds would panic and immediately try to withdraw their money. So they've deployed a financial accounting trick so egregious, so fundamentally dishonest, that it should be illegal. But because private credit operates in the regulatory shadows, it's perfectly allowed. It's called payment in kind, or PIK for short. Here's how this scam works. When a borrower can't afford to pay the monthly interest in actual cash, the lender generously allows them to toggle to PIK. Instead of writing a check, the company pays the interest with more debt. The lender simply adds the unpaid interest to the principal balance of the loan, so every month the total debt grows larger. The company sinks deeper into insolvency. The death spiral accelerates. But here's the truly criminal part. The lender then records this phantom interest as real income on their financial statements to investors. They report to the pension funds that the loan is performing perfectly and generating high yields, despite the complete absence of actual cash flow. The quarterly statements show healthy returns. The pension fund managers see stable income. Everyone pretends the system is working, but the emperor has no clothes. The International Monetary Fund has explicitly warned that PIK accounting is systematically masking the true default rate across the entire U.S. corporate sector. If these loans were marked to their actual liquidation value, what they would sell for in a real market, the default rate would be catastrophically higher than official statistics suggest. But private credit loans don't trade on public exchanges. There's no daily market price to prove the manager's wrong. They're allowed to use mark-to-model valuation, which is a polite way of saying they guess what the loan is worth based on their own optimistic internal assumptions. This creates a terrifying valuation gap between what the funds claim these assets are worth and their actual economic reality. We're already seeing proof of this gap in the secondary market where distressed loans are quietly traded among sophisticated investors. These buyers, who actually understand credit risk, are demanding massive discounts. They're paying 60 or 70 cents on the dollar for loans that pension funds have marked at par value. This implies that pension funds are currently sitting on tens of billions of dollars in unrealized losses that haven't been acknowledged yet. Paper losses that will become very real losses the moment they try to sell. And here's the nightmare scenario that keeps regulators awake at night. Pension funds are legally required to pay current retirees. When a 65-year-old teacher retires, the pension must write checks every month for the rest of her life. If the pension fund needs to raise cash to pay current retirees and tries to sell these private credit loans, they'll instantly crystallize those massive hidden losses. The fund's solvency could evaporate overnight. This illiquidity, this inability to quickly sell assets, is the single most dangerous characteristic of the private credit market. You cannot sell a private credit loan in 3 days like you can sell a stock or a treasury bond. It takes months of complex legal negotiation to find a buyer willing to take on an illiquid asset. And in a crisis, when everyone wants to sell simultaneously, buyers simply vanish from the market entirely. This leads to a mechanism called gating, where fund managers legally lock the doors and forbid any withdrawals for an extended period. We've already seen this happen in commercial real estate funds. It's now spreading to credit funds. Imagine this. You've worked for 30 years, diligently contributing to your pension. You finally reach retirement age. You submit your withdrawal request, and you're told you cannot access your own money because the fund has been gated indefinitely. This is not a hypothetical scenario. Federal regulators are quietly preparing for exactly this eventuality right now. The exposure isn't limited to a few wealthy individuals gambling in hedge funds. This is systemic. This is widespread. This affects the working class of America. Public pension funds, which manage retirement savings for teachers, firefighters, nurses, police officers, and municipal workers, have some of the highest allocations to private credit. They chased yield to plug their own chronic underfunding gaps, and now they're trapped in positions they cannot exit without devastating losses. When this crisis accelerates, not if, but when, state governments will face an impossible choice. Either slash retirement benefits for public workers who've already retired, or dramatically raise taxes on working families to fill the funding hole. Either way, the risk gets transferred from private sector speculation directly onto taxpayers, just like 2008. But here's what makes this crisis even more dangerous than 2008. The Federal Reserve has extremely limited tools to fix it. They cannot buy these loans to stabilize prices because they're not government-guaranteed securities. They cannot lower interest rates back to zero to save the borrowers without reigniting inflation, which would be political suicide. The zombie companies are left to rot under the crushing weight of debt service they cannot afford. The impact on Main Street America will be a slow, grinding suffocation of economic growth, investment, and job creation. These mid-sized companies employ millions of Americans. They're currently in strict hiring freezes to conserve cash for interest payments. As they cut costs even further, layoffs will inevitably accelerate. We're already seeing early warning signs in the labor market data, carefully hidden beneath headline unemployment numbers that still look stable. And then there's the maturity wall. Hundreds of billions of dollars in private credit loans are scheduled to mature in the next 24 months. These loans must be either repaid in full or refinanced into new loans. But refinancing is mathematically impossible at today's dramatically higher interest rates. A company that borrowed at 5% cannot possibly afford to refinance at 13%. The math doesn't work. The business model collapses. Lenders will face a brutal choice: force the company into immediate bankruptcy, or inject additional money to artificially keep it alive. Injecting new money, what's called a NAV loan, is just throwing good money after bad. It increases leverage on top of existing leverage, compounding the risk of total catastrophic collapse down the road. This leverage-on-leverage structure is the classic warning sign of a financial bubble stretched to its absolute breaking point. The insiders know the music is stopping. They're quietly trying to exit before the panic starts. But the exits are small, and the amount of money trying to leave is overwhelming. This imbalance creates a stampede that drives prices down vertically, wiping out equity value in moments. The epicenter of this earthquake isn't in Manhattan skyscrapers. It's in your local dentist's office, your veterinary clinic, your urgent care center, and your community hospital. These healthcare businesses were aggressively targeted by private equity during the era of free money. They were considered recession-proof because people need healthcare regardless of economic conditions. Private equity firms used a roll-up strategy, buying dozens of small independent practices and consolidating them into giant corporations, all funded with massive amounts of floating-rate private credit debt. The plan was simple: cut costs, raise prices, and sell for enormous profits. But that strategy was entirely dependent on cheap debt service. Now that interest rates have tripled, the economics of healthcare roll-ups have completely collapsed. Debt payments have skyrocketed, consuming cash flow that should be funding patient care. This is why you're seeing emergency rooms suddenly close, staffing cuts at local clinics, and deteriorating care quality. The money that should pay for nurses and medical equipment is being extracted to pay interest on loans to financial firms. The financialization of American healthcare is hitting the concrete wall of monetary reality. The losses have already happened. They just haven't been officially recognized on balance sheets yet. When the recognition moment comes, when pension funds are forced to admit the true value of these assets, it will shock both the financial world and the millions of ordinary Americans who trusted the system. But for those who've been paying attention to the mathematics, it won't be a surprise at all. The shadow crash isn't a future possibility. It's a process unfolding right now, in real time, hidden from public view by accounting conventions and regulatory blind spots. Your financial safety depends entirely on understanding the mechanics of this bubble before it bursts completely into public consciousness. The time to ask hard questions of your fund manager is right now, before the gates lock and your capital gets trapped inside an illiquid fund spiraling toward insolvency. Because once the panic starts, logic and liquidity vanish from markets instantly. We are standing at the edge of the largest credit reset in modern history, and the ground beneath us is already crumbling.